Who's Afraid and Why? My name is Renee Friedman. I'm Global Head of Research at EXANTE, and I'm very pleased to be joined today by independent global market strategist and former chief currency strategist at Citi, 𝗵𝗲 and Louis-Vincent 𝗂𝗏, CEO of 𝗂𝗶𝗀𝗏 Research. I may add, this is a very global webinar with so we'll be giving a very interesting perspective because I'm in London, 𝗵𝗲 is in New York, and Louis-Vincent is in China, calling in from Beijing. So hopefully, if we do have some connectivity issues, blame the Great Wall. Okay, let's kick off on what is going to be, I think, a fascinating discussion. The first thing I really want to discuss is the fact that if we're 5 days out, I think, from the US election, and right now polls are running pretty much neck and neck. And therefore, I want to kind of ask this question of why this is happening, what the polls actually mean in terms of the prediction markets, which are very much focused on a Trump win versus the opinion polls. Are the polls getting it wrong? Are markets getting it wrong? And what do we think that this is having in terms of the effect on market pricing, on equities, on bonds at the moment? So I'm going to throw that question out there. Whoever would like to go first. 𝗵𝗲, okay.
So first of all, good morning, and very glad to join from New York, where I successfully avoided joining any of the rallies or watched baseball over the last few days. And as you said, it's getting to be really exciting over the next few. And let me say three things about the predicted election outcome and the market implications. And the first is I agree with the prediction markets, which isn't the same as saying that I think that they're a good polling summary or that they're a great source of information, but it's really just that my own analysis aligns with that of the prediction markets. And that's really because of the context of the election, very well illustrated by the Gallup survey that asks people, which party do you identify with? How do you think about the direction of the country or the economy? But also, what are the main issues that voters care about? And all three questions, which historically have been really, really predictive for the outcome of the election, are suggesting that this is the Republicans' turn, and it is also time for a change in government. So this is a really useful source of information for me. Secondarily, what we see is even though the polls nationally are close on average, the swing state ones are a lot less close than they were the last couple of times. So if you have a similar type polling error, which is probably not exactly the right way to think about it, but nevertheless, those swing state polls actually skew a lot more towards the Republican side than they did before as well. And similarly, the information that we're getting from early voting too looks a lot better than it did in 2020 and in 2016. So the first point is I agree with the prediction markets, but that's not where we take my main cue from. The second point is there still a path to victory? There is, and for the Democrats, and that is because young people or voters, young people or women may turn out in very large shares. So I think that's the area to watch. Turnout on the day can depend on many things, including the weather, but there's clearly a major turnout effort going on. But it'll really be down to these two demographics. But even there, the Democrats are doing okay, but they're doing less well, if anything, than in 2020. So it doesn't change the outcome, but we certainly need to be prepared for surprises, which we've seen. And then a quick comment on markets, which have clearly been pricing in increasing odds of a Trump victory, and I think that makes sense. So I don't disagree with the market pricing in the macro or in the micro. But what I want to highlight about the pricing that is really unusual this time around is that historically, markets were pricing a risk premium in equities going into big events, including elections. And that's really important because you tend to want to buy the asset that is having a big risk premium. This time around, the risk premium is in bonds. So bond yields have been going up, bond prices have been going down in the US for a variety of factors, but clearly the increasing odds of a Trump victory are playing into that as well. And that's why I think it is really interesting or the reason why I think that's really interesting is, again, historically, it makes sense to buy the asset that is selling off into an election. So against the common grain and against my medium-term view, I actually think there are a good number of scenarios where bond yields could actually slightly drop after the election, not quite irrespective of the election outcome, but under quite a few scenarios.
louis-Vincent, any response to that?
No, look, first of all, thanks a lot for having me. It's a real pleasure to be here. I want to apologize if my internet connection is somewhat unstable. I'm in Beijing, and sometimes the Great Wall of China can prove somewhat daunting. So apologies for that. I agree, with everything that Ibrahim said. I think at this point, indeed, the market has started to price in a Trump win, which, for all the reason Ibrahim just highlighted, is where the odds should be. Now, having said that, is the market pricing it right? What have we seen in the past few weeks? We've seen gold go up a lot. To me, yeah, that makes sense. In a world in which Trump is president, I think he's been pretty vocal about his desire to drive the US dollar down. So, gold could be an easy reflection of that. He's also been quite vocal about his desires to beat up certain countries with tariffs, turn the US more protectionist. So, if you're China, why not move more of your reserves into gold? If you're in India, if you're any one of many countries. So all that makes sense. Does it make sense that US Treasury should sell off? Well, yeah, I think that also makes sense. Hardly a day goes by without Trump promising new tax cuts and more government spending. So yeah, that also makes sense. Perhaps to me, the part what you have seen as well in markets is on the back of hopes of a Trump win, is a big broadening of the performance in the equity markets. It's no longer equity markets that are driven just by your Max 7 stocks, but you've started to see an outperformance of financials, an outperformance of cyclicals, which again, in an environment where Trump deregulates and goes on a big fiscal easing, all of that probably makes sense. The part to me that leaves me a little bit scratching my head is probably the value of the US dollar. Here Trump has been very, very vocal on his desire to weaken the US dollar. He's been very vocal on his desire to get the Japanese to revalue the massively undervalued yen, to get the Chinese to revalue the massively undervalued renminbi, and even to beat up the Europeans to revalue the euro. And in recent days, you've seen, or in recent weeks, you've seen a US dollar that has firmed up, and that to me is the part that perhaps leaves me somewhat pensive, because again, I tend to think that a Trump presidency should conceptually be weak for the US dollar. It was last time around, at the very least. That when Trump left office, the US dollar was weaker than when it came in. So I don't know. That's the part that leaves me a little bit scratching my head.
Okay, interesting points on that. Now, the one thing I would say add to that is obviously the US economy is performing extremely well. We've had GDP numbers coming through yesterday, came in at 2.8%, slightly down from the 3% previous quarter. We've got, as I said, equity markets have been reaching highs this year, but there are growing concerns about the overvaluation in stocks. They are looking quite stretched. Yes, we have seen some broadening out into the market, but perhaps not enough. I guess the other big thing that really comes to mind, and this kind of goes to the point that you hinted to, Ibrahim, is, and this will also impact the dollar in terms of that medium-term outlook. Because obviously, we already know historically when there's an election, generally equity markets are relatively stable 6 months after, right? However, we're in a business cycle period of change, pretty much. We're looking at a Fed that was cutting rates, and there may be less pressure on it to cut now. We also have an issue, though, of the fact that we have high debt levels. globally. We have rising debt within the US. If we have this expansionary fiscal policy, regardless of candidate, we're likely to have higher debt levels still. We're already paying, the US is already paying quite high levels of debt interest, and that does worry markets a little bit. And so looking at these factors, or considering those particular factors, you know, where does that leave us in potentially in the medium term, as opposed to that immediate short term or even longer term market outcome? So I'm talking about, you know, into the latter part of next year and into 2026, because obviously whoever gets in won't be officially sworn in until Q1 next year.
So let me again, I like threes. So let me try to make 3 points. I mean, the first is, if we think about the US economy today, then as you said, the broad thrust of it is positive, or at least I'm on the optimistic side of the debate. And I really boil it down structurally to the very strong resilience of private sector balance sheets in the US, both household and corporate. But let me put the emphasis on the corporate side, on the household side, where we've seen in particular household net worth rise tremendously over the last really decade and a half, but it continues to add roughly a third of GDP almost every year. And the reason why I highlight that is because it's also a good differential. That's what distinguishes the US from a lot of the other economies. So the US outlook is very positive, irrespective of the election outcome. But at the same time, if we think about that medium-term horizon, clearly we are in the latter innings of this cycle. So into next year, the growth outlook looks great. Anything beyond that, you have to factor in, medium-term downturn risks, not just in the economy, but in financial markets, including that eventual reversal in the equity market as well. The second point is, where does the election matter? And Louison already alluded to it. I mean, there are 3 areas where I think we can see pretty clear differences in the election outcome, even if it's just about the presidency, and that's around tariffs and border policies, including immigration. It's in deregulation, and it's in aspects of foreign policy, where I guess the Ukraine-Russia war is the most important. And these things matter. They matter economically, but if we think of it, they matter clearly for the sectors, which will perform relatively differently under those outcomes, meaningfully. But at the macro level, to some degree, they're also offsetting. So if we think about deregulation as having a positive impact on growth, reduced immigration and some modest amount of deportations will have a negative impact on growth. And there are similar considerations you can make about tariffs even, where they will probably bring in investment into the US, and at the same time, they themselves will have some negative growth impacts too. So the medium-term macro picture, I think, is somewhat muddy between those clear differentiating factors across the election outcomes. And again, leaving aside the general point that, of course, a lot depends on whether we will have unified government, which is much more likely under a Trump presidency than under a Harris win. But my third point is, what's so far been missing in this debate by me, even though Louison mentioned it already, is fiscal policy, where I think the immediate market response is clearly, or is likely going to align, in particular, a Republican sweep with more expansive fiscal policy. There are risks for markets attached to it. But if we really think through what will happen over the next couple of years, I think fiscal policy outcomes in the US are going to be much more constrained, and maybe in the end, much less different between the various outcomes in the election than you may think at first glance. And that's partly, quote unquote, for good reasons. Again, the US economy is doing well. So even if Trump is winning a unified government, there's a chance that his advisors will make clear to him that the last thing the US will need, if it continues to do well, is even more fiscal stimulus. So even if he had the power, I'm not sure how much he would do. Similarly, if we get what is seen to be maybe as more of a consolidating public finances outcome, a Harris victory with divided government, I don't really see who is going to really force, other than maybe inflation or the bond vigilantes, but in the political spectrum, I'm not really sure who's going to really force the next administration to proactively tighten fiscal policy. And if the last decade or so have been any guide in terms of US policy, it is that even when there are big divisions of opinion, they tend to get resolved by giving each party kind of what it wants. And that's so far never really been a fiscally consolidating outcome. So just overall, I would say the medium-term implications macro-wise are not that obvious to me, and not that obvious to position for them. For now, I would outside of the immediate election window, I vote with continued US resilience and good performance.
Do you feel the same, Vincent? Louis Vincent?
I do, actually. I don't find much to. I'm sorry. You wish you'd have people who'd fight with bare knuckles and disagree on everything. But no, I don't disagree with in much with what Ibrahim said. What I would say is, look, if you look at this U.S. election, you can make many kinds of scenarios. Depending who wins the presidency, who wins the House. You can make different scenarios on how the Fed reacts to the various outcomes. So let's look at the potential scary scenarios, the one that investors should worry about. So I think that the first potential scary scenario, the one that today seems to grab most people's attention, is you get a red sweep, and that Trump sees this as a sort of carte blanche to go full protectionist, and that you go down the path of massive protectionism, big trade barriers, send a lot of illegal immigrants home. And it seems to me, at least from Beijing, where I'm having meetings right now, this is the scenario that most people, at least outside of the US, are possibly the most worried about. And funnily enough, I'm not that worried about it, because I think that when it comes to Trump and his protectionism, the bark tends to be a whole lot worse than his bite. I think we saw that in 2016. He was elected, if you remember, and the Mexican peso got crushed, the Mexican bond market got crushed, the Mexican equity market got crushed, because during the campaign, there weren't enough bad words in the dictionary for him to describe Mexicans. I'm not going to repeat the insults he had on Mexicans at the time. And then what happened? He got elected. He sat down with the Mexican president. Very, very quickly, he renegotiated a NAFTA, rebranded it to USMCA, and we were off to the races. And in the following 5 years, the Mexican peso was the world's best performing currency. The Mexican bond market was the best performing bond market, and Mexican stocks did fine. And so, today I think there's a lot of fear of the protectionist turn. And to me, these fears are overblown for a number of reasons, but I don't want to belabor the point. I think there's a second, perhaps somewhat more worrying scenario, you could say, is you get the GOP sweep, and you get the very aggressive fiscal plans, the tax cuts, the extra spending, etc. And the Fed turns around and says, not on my watch. And that you get into a situation perhaps not that dissimilar to what you had in Germany after reunification, when Helmut Kohl basically said, we're reunifying, I'm going to spend a lot of money, I'm going to rebuild East Germany. And the Bundesbank said, well, we're not paying for this, and hiked interest rates in the face of Kohl's spending plans, which created this sort of vacuum, as you had very lax fiscal policy and very tight monetary policy. It created this vacuum where basically Germany sucked in all of Europe's capital. Deutschmark went up. Eventually, we all know that's how Soros made his billion betting against the pound, when the pound was forced out of the ERM. Italy was forced out of the ERM. Sweden went bust. And because basically nobody could keep up with Germany's very high real rates. Now, again, I'm not saying this is going to happen. I think there's reasons to think things are quite different this time. But this is a scenario where perhaps we have to be attuned to. The possibility that in the US you end up with much easier fiscal policy, but perhaps tighter monetary policy that people are expecting, and that this creates some real discrepancies in markets. And then I would say that the third potential scenario that we have to worry about, which perhaps might be more likely than is currently priced in by markets, is the possibility that Kamala Harris wins the White House and the Republicans keep the House. And the reason this matters is that we know that when they control the House and there's a Democrat in the White House, the Republicans suddenly remember that they're supposed to be the party of fiscal rectitude. And it is at these times that they decide to slash government spending and tackle budget deficits. And so today, I think, you know, the markets are obviously priced for a continuation of economic expansion. They're priced for a continuation of very wide budget deficits. But if the House says, look, party's over, we're now, we're not going to cut the funding for the federal government, then you could easily push the system into a recession, and a recession that gets pretty big with then a stronger dollar and much lower bond yields. So I'm not saying, to be very clear, that any one of these three outcomes is going to happen. I actually don't believe one of these three outcomes is going to happen. Nonetheless, you have to come in open-minded, and I would say that if on the night you find out that Harris won the White House and the Republicans kept the House, I think you want to de-risk your portfolios quite meaningfully.
Very interesting points on that. And just kind of coming back to the point that you made about what, if the Republicans controlled Congress, what would actually happen if we had a Harris win? And again, because these polls are too close to call, and we can get into discussions about who will actually concede, and whether or not these votes will be contested in swing states and the implications of that on markets. But if we do have that happening, we do have that fiscal cliff coming in January with the new budget. And even though the Republicans, as you say, might want to say, okay, we're the party of fiscal austerity, not quite austerity, but being fiscally tighter than the Democrats, they may be looking at some of those things in that potential budget, such as some of the aspects of the Inflation Reduction Act that Harris would likely want to continue, that was brought in a couple of years ago, because many of the beneficiaries of that Inflation Reduction Act are actually businesses in the south of the US, and these are in Republican-controlled states. So would we actually see as much of a pushback as a result? Because in many of the states that are Republican-leaning, they've been benefiting quite substantially from the fiscal policies of the current administration.
So on this, I think if you look at state by state, you may be able to indeed swing the odd senator, but I'm not even convinced. I think when you look at district by district, what you find is partly through gerrymandering and the redrawing of various districts, what you find is that on both the Democratic side and the Republican side, you've made districts that are now much more partisan than they've ever been historically, and that's why you get this sort of 90% incumbency rate where incumbents keep getting reelected, etc. The map has been redrawn to such extents that, and when you look at how districts are drawn, sometimes it looks like modern art figures cutting across the map of the United States. So I don't know. You would think that a lot of these guys would be bought off by projects in their districts. I'm not convinced. I think if Harris wins, the Republican Party is going to be crushed. It's going to be very disappointed. It's going to probably feel that it was cheated because, right now they're all feeling we've got the momentum, we've got the betting markets are telling us we're winning. The polls in the swing states are telling us we're winning. So if we ended up losing, surely the Democrats must have cheated. That I think the idea of we come together and all start working together for a greater good, I'm very doubtful.
I think I agree with you. The likelihood of that, we'll probably see if Harris were to get into office, and if we do have, as you both have alluded to, the very strong potential for a Republican-controlled Congress, we'd most likely see a lot more executive orders coming through from the Harris administration, or potential Harris administration. And of course, that would cause a lot of political conflagration within the US itself, difficulty within the US itself. I just want to get quickly back to that point that I just raised earlier in terms of the margin of the win. So even if Trump wins everything, which predictive markets seem to indicate, and both of you seem to support, what about that margin of the win? What does that actually represent to markets in terms of stability? And again, we're getting back to that issue of contested votes. This could be an election that is quite drawn out. We still have a number of lawsuits, over 100, I think, going on related to the vote. And there could be a time frame which we have a general lack of clarity around who actually wins. Do you think that that's something markets should be worried about, both within the US and external to the US? Or is it of no concern, really?
So my take would be, again, probably three comments here. The first one is, I think polls ex-ante being closed is not the same as ex-post. And that's because a lot of the polling errors tend to be correlated. And we saw this in the last two presidential elections. And therefore, again, the base case is, and it's really quite plausible, that not only will the outcome be relatively clear, but maybe we won't even have to wait all that long. And the last election, certainly for the presidency, was again fairly illustrative in that regard. We had, lots of movements, lots of lawsuits, et cetera, but we really knew the outcome. Markets had priced the outcome and were off to the races by the morning of the day after, and that was despite the fact that many aspects were still to be resolved. So I will certainly keep that in mind, that we could end up having a relatively clear outcome, in which case, of course, markets can move on quickly. Secondly, there are a number of scenarios under which the outcome could be close enough that there'll be some uncertainty. And I highlight two that are, I would say, relatively benign. I think there is an outcome where you simply have to wait a little bit, but it becomes clear that the president will be Trump, and that is, I think, again, not so different from what we had last time around, and it certainly will give you some jitters on the night, as people have to certainly factor in a greater likelihood that maybe he will not win. But if that result comes through relatively clearly, it will be a dip to buy, if you like. And somewhat similarly, I think the outcome where you have clarity on the presidency, but it's really the House that is unclear, which is much more plausible. So the House in particular is meant to be pretty close, and there's much more room for recounts and such like to potentially end up making the difference there. No matter who wins the presidency in that regard, that might, after that initial draw, not be that worrying in the end. The outcome of the House by itself will not worry markets all that much. Again, conditional on who won the presidency. Again, it will be a disappointment if Harris wins the presidency for markets in certain aspects of markets. But I don't think that will get made much worse by having to wait for the outcome for the House. Similarly, if Trump wins the presidency, we don't quite know what happens in the House. I think there'll be momentary reflection, but this is not going to be a big disturbance to markets. And then it's really the last case, and that's to the point that Louis Vuitton raised, that would be a big problem, which is that President Trump, or Trump loses the presidency by the tiniest of margins. Maybe it will take a long time, or maybe even early on we find out that it is the tiniest of margins, and that will invite a lot of questioning about the election outcome. And it's not necessarily so much about the lawsuits, even though they clearly won't help, but it is really the potentially contested nature of those elections, the potential for some type of unrest that it could galvanize. And I do think that would be a serious risk to consider for markets. So in that scenario, and it's very hard to put odds on it. It's clearly not the base case, I think, but it's hard to dismiss that risk entirely. And I think that could get you quite a meaningful, difficult period for markets. So not only does the disappointment come with the election outcome, but that the contested nature of it, away from the legalities and some of the procedural issues, which are important but not decisive, I think, at present. That's really one that, as the title goes, investors may have to be afraid of.
So I agree completely. I'll just add one quick thing. You know, after the past, you know, we know the U.S. is a very divided nation. We know it's a 50-50 nation. And after the past contested, you know, elections, I think if you get a very decisive outcome, one way or the other, the markets will act with relief. It'll be if you get a very clear winner, where, you know, the other side can't say that there's been fraud or there's been Russian interference or whatever else. If you get a decisive win, I think it's great news, regardless of who wins. A decisive win would be tremendous.
Okay, so we'll be keeping a very close look at, particularly within the swing states and in the and as you've mentioned, many of the districts themselves have been gerrymandered over the past decade or so, or longer.
And Renee, just to as a quick comment, because we happen to agree a lot on the call, Louis and I'm really privileged to have him on the panel with us today. My slide, and it's not quite a disagreement, but I think the nuance this time around is because I mentioned already, I strongly believe in the importance of risk premium for big events, and they've historically been, you know, you sell the uncertainty and you buy the outcome. This time around, what I mentioned earlier, what is really unusual is the uncertainty is in the bond market and not in the equity market, and that matters both ways. It matters that you could end up seeing, you know, what right now is against the grain of sentiment and market pricing, which is you may actually want to buy bonds, or you at least want to be more ready to harvest some premium that insures other people against higher yields, and that is because either you could get the unexpected outcome, the more fiscally responsible outcome, loosely associated with a Harris victory. But it could also simply be that so much has been priced in now in terms of higher yields and expectations that it's very hard for markets to climb that hurdle. And the reason why I make this comment is there is a related point on the equity side, which is we are pricing much less in terms of equity downside risks into this election. And my outlook for the next 6 months, even into the end of the year in general, is really quite positive for equity markets. But we have taken out much less insurance against downside risks for this election than we did previously. So I think that there are two scenarios where you have a clear election outcome and it could still not turn out too well for equity markets. And I think it is a Harris victory, where simply I think there'll be a number of bets that need to be recalibrated at a minimum, and maybe that'll last a little bit longer than, again, pricing today would already reflect. And the other, Louis already mentioned it, is you get the over-exuberant Republican victory. You get the bond vigilantes to be awoken. And the reason why that's interesting is again, simply because of the setup in markets. We are at US real yields at 2%. We're at levels of the VIX that are, you know, maybe not high relative to where they were in the 2020 election, but they're at levels which historically are relatively close, where they could start to be somewhat disruptive. If you don't get the vol crash post-election, that's a somewhat more fragile outlook for equity markets. So I see it a little similar to what Louis said about risks. It's not really my best case outcome, but it is something which is quite different this time around from the others.
It's a very good point. Okay, I want to get into one point to the fact that the wider implications of this election and why these elections may actually be scarier outside of the US. We know that European companies are already feeling the impact in terms of all the talk around tariffs. China, of course, which, as 𝗬𝗏 has pointed out previously, is not as dependent on the US for its revenues in terms of its exports, but it will also be impacted. And of course, there's the effect that will have on emerging markets, emerging market currencies, emerging market growth. So my question to both of you is, who should be the most afraid and why, or why not?
I'll take the why not, actually.
Okay.
I'll take the why not. I think that look, the Trump obviously, you know, a big part of the rhetoric is the bashing of foreigners. And in fairness to Trump, it's a fairly he's very equal in his bashing. He'll bash Europeans, he'll bash Mexicans, he'll bash Chinese, he'll bash Japanese. He's very non-discriminate in that regards.
He hates them all equally. Yeah.
Yeah. No, if you're a foreigner, you're wrongin'. Now, having said that, again, if we go back to 2016, you know, he spent the whole campaign bashing Mexico and then renegotiated a deal that wasn't that bad. What he did do in his first term is that he single-handedly changed the narrative in Washington, D.C. around China. You know, when he came in, everybody in Washington, D.C. believed in engaging China, in doing more work with China. And by the time he left, China had become this big bad enemy. And that to me is really the big question, is where does the U.S.-China relationship go under a Trump presidency? Now, I think the consensus out there is that it can only go from bad to worse. That, you know, the U.S.-China relationship is already at rock bottom, and that once he arrives, Trump will take a big shovel and dig an even bigger hole. I see it differently. Because first, I believe that Trump is first and foremost transactional. His animosity towards China is not ideologically driven. It's very economically driven. You see this in his campaign speeches. He keeps saying that he wants BYD to open a factory in Michigan and the autos to open a factory in Tennessee and so on. Things that you know, Biden never said or would have never agreed to in the first place. So, you know, it seems to me that the market today is priced for Trump coming in and being a bad news for China. You saw this in the past 3 weeks. As Trump's polls have come back up, the Chinese stock market have rolled over and fallen hard. And it could very well be that Trump gets elected and China gets a bit of a kicking. But imagine if on the other side, you get some kind of news of a grand bargain where China agrees to open factories in the United States, perhaps agrees to revalue the renminbi, agrees to buy more U.S. treasuries, agrees to buy more Boeing planes or more tons of American soybeans. And against that, China is allowed to once again buy high-end semiconductors and semiconductor equipment manufacturers. Perhaps China, you know, you see some settlement over the tariffs. There's a lot of things that actually the U.S. and China could negotiate over and find a compromise and find a deal. And let's not forget that, you know, Trump does see himself as a deal maker and actually is out on the campaign trail saying that what he really enjoys about the presidency is cutting deals. He said it again just a couple of days ago at one of his big rallies. And so if the market starts sensing that you could actually, instead of having a big confrontation between the US and China, you have some kind of grand bargain that is struck, then I think you come into 2025 with, on the one hand, China stimulating, and on the other, some kind of grand bargain. And it could be a big re-rating of a number of assets under such circumstances. So long story short, I think people are very afraid of Trump the protectionist. I'm actually hopeful on Trump the deal maker.
It's a very interesting angle. Ibrahim?
I find Louis Vuitton's argument very compelling. I also, on the China side, I mostly defer to him, but I would also say there's really very little upside for China under a Biden administration. And if anything, you will face more uncertainty. And we know that markets and investors dislike uncertainty. But let me offer one each in who should be maybe afraid and who maybe less than the markets are currently pricing. I would say in a similar category as the the Chinese, maybe degree of resilience is Mexico. And that's not so much because nothing can happen. We clearly will see some degree of pressure on maybe trying to renegotiate aspects. I would say that is a constraint limit because it's US corporates that have really been an interested party in not rocking the boat too much. But what I'm really trying to get at here is that this is an extremely well-flagged risk for markets. For example, dollar Mexican exchange rate has been really strong of late. What is priced in terms of the volatility around the event is very high. There are obviously a couple of macro factors, both on the US and on the Mexican side, that have supported that trend going into it. But this is just to say that at this very moment, the risks for the US-Mexican trade relationship are really well priced, and it is one of the areas of the US election outcome which are relatively more priced, and it's more priced, relatively speaking, than perhaps issues even on the China-sensitive asset side. So I think that's not necessarily an argument for buying the Mexican peso today or even on the eve of the election night. But basically, but for example, in 2016, we saw the low in the Mexican peso shortly after the election. So again, a big risk premium price usually is a good time to buy, and that might apply for the Mexican peso. But there are areas, and let's call it 1 to 2, that are clearly going to be at risk in a Trump presidency, and that is Europe, the European Union in particular. It is going to be in Trump's side because he has historically been guided by a relatively simple arithmetic. He looks at areas of the world which tend to have some combination of a bilateral trade surplus with the US, maybe an overall current account surplus, and maybe some measure of higher tariffs than the US does. The idea of reciprocity was very prominent, continues to be very prominent, and the EU scores very highly in that regard. I think he perceives a power imbalance, which we know affects Trump's behavior as well. And ideologically, he isn't all that favorable towards the EU as well. So I think European economies are going to be challenged, and that is also in part because the broader dynamic supports what I would call supply chain and market diversification for European companies. So I think Europe is a little more in the crosshairs in the outcome of the Trump victory. And if you interpret the idea of Europe a little bit more widely, then clearly the election outcome is going to have an impact on US postures and attitudes towards the war in Ukraine. So I would expect less support by the US for Ukraine in terms of military aid and more generally in terms of continuing the war. So that could be quite a big outcome, a big impact of the election. Now, to some degree, that may end up being a slight positive over time for the European economy. So there are some silver linings for Europe. It's generally going to be under pressure. Maybe it will help resolve the war on its borders. And more broadly, European companies are themselves a little bit more diversified than European economies are. So it's not all negative news under Trump victory, even for Europe.
Okay, given all that, that actually gives me a good head move into the question on the impact on alliances and trade. As we are looking at elections in parts of Europe next year, potentially if things do calm down in the Middle East, we'll be looking at elections in Israel if the situation there stabilizes. And this will have a longer term effect. If Trump gets into office, on all the alliances that we see, will also have an effect on global oil prices potentially, and again, global growth. So what do we think that overall, the election, whoever wins, how much that will really influence those alliances, that it will influence changes in global trade? Will it, reinforce friendshoring or nearshoring or onshoring or discourage it? Any points of view on that?
Yeah, look, I think it's pretty clear that Trump isn't a very big fan of alliances, that he's very keen on the U.S. having a lot of foreign commitments, and that he's actually very keen for U.S. allies to step up and take care of their own problems. So yeah, it's hard to imagine that after 4 years of Trump presidency, any of the major alliances come out much strengthened, and it doesn't take much imagination to see them weakened going forward. I think Trump is he's not one for multilateralism. We know he's all about one-on-one relationships. Now, I think he obviously feels very strongly about the U.S.-Israel relationship. He feels very strongly about the U.S.-Saudi relationship. He doesn't really feel that strongly about any of the U.S.-European relationships. So, where does all that leave us? I think he'll come in. He'll try to sell a lot of weapons to Saudi. He'll continue pushing the Europeans to step up their defense spending, which comes at a pretty inopportune times for European countries that are, a number of whom are either dealing with recessions like Germany, or dealing with already big fiscal crises like France. So the cash to massively increase defense spending, whether you look at the UK, whether you look at France, whether you look at Germany, might really not be there. But yet, and to Ibrahim's point, European countries may well have to do that anyway. It feels like we're coming to an end to the Ukraine war, an end that is probably going to be it's going to be a defeat for Ukraine and thus a defeat for Europe. And out of that defeat, we should increase our defense spending, again, with budgets that can't really afford to. So I would say, none of that is very bullish for the euro currency itself. None of that is very bullish for the European area. The reality is, we've piggybacked. I say we because I'm French. We've piggybacked on U.S. military spending and U.S. protection for years, and Trump is very, very keen on highlighting that free riding is probably coming to an end.
Yeah, it's a very good point on that, and thank you for mentioning that in terms of euro and euro depreciation, because if we are looking at dollar strengthening, which would be the result of going back to the beginning of the conversation of these higher yields staying in play for an extended period of time, that is most likely what we'll continue to see happening, a weakening of the euro. Potentially, what do you either of you give the odds of the euro as a result moving down almost towards parity with the dollar?
I certainly think it's a plausible scenario. I mean, I would throw in that I think the broader thrust globally in terms of alliances, etc., isn't, I think, decisively going to be changed by the outcome of this election. There are these impacts that we saw highlighted, but we are in a multipolar world, and the Biden administration really made very little difference to that. And I think that people point to tariffs. I think it's a good illustration. You didn't roll back any of the tariffs, but if we even think about those broad alliances, yes, there was maybe a little bit more cooperation around Ukraine, but generally speaking, it was really just mood music, and the atmospherics changed. I think the outcomes for international alliances didn't change it. So the global south is kind of gone from a U.S. perspective. It's not so obvious what the U.S. Would offer it, and again, Europe will be more differentially affected by the outcome. And I would put that into the general trajectory for dollar strength with a European specific flavor. Now, we've traveled some way. It's not an unmitigated bad, but could we see parity in euro dollar in a continued period of Trump victory-led U.S. outperformance into the first half of next year? I would say I put at least a 1/3 odds on that. So certainly very much in the realm of possibility.
I agree with that. I would add that, look, almost regardless of what happens in the U.S., things really aren't looking that great in Europe. Again, you've got genuine economic problems in Germany, a genuine political crisis in France that's going to morph into a fiscal crisis. And the reason this matters is if you look at historically, you've always needed either Germany or France to lead in the European Union, partly because the whole apparatus of the European Union, when you go to Brussels, it's all manned by German or French civil servants. And the reality today is that you have a true vacuum at the top of the German and French political structures. Neither Olaf Scholz nor Emmanuel Macron carry any kind of respect, carry any kind of weight, whether domestically or internationally. And so, if you're, for whatever reason does hit the skids, I think this lack of leadership, more often than not, the exchange rate is the first variable of adjustment. So that's on a political front. Then you look on an economic front. The real challenge, I think, that Europe is confronting today is that pretty much all the industries that Europe used to be very good in, the autos, the industrial robots, the specialty steels, the chemicals, any one of these sectors, China has done such progress in over the past 5 years. The big macro story of the past 5 years is how China, in industry vertical after industry vertical, has leapfrogged the West. China is now the biggest car exporter in the world. Who would have bet on that just 3 years ago? If you'd said that at a dinner party 3 years ago, that you were thinking of buying a Chinese car, people would have laughed in your face. And so, I think this surge in Chinese industry is a challenge for the whole world, but it's especially a challenge for Europe, because that was one of our few comparative advantages. And again, I say we because I'm French. It was one of our few comparative advantages, and that's being taken away. You look at it, the only way Europe can compete today is if the exchange rate comes down.
Okay.
And let me just quickly throw in the pendant to Louis Vuitton's French is I'm German. I know my name and face don't necessarily give it away, but the accent does. And the one thing I would add, and it's more of a medium-term orientation, is we also know that Europe and Germany specifically only change under pressure, or as you can put it, they do the right thing once all of the other opportunities are exhausted. And I think that I highlight that for two reasons. I mean, number one is we will have a new government in Germany over time, and that government will have somewhat more freedom to be active. Will it do the right things? It remains to be seen, but there's certainly a lot of reasons to think that we will see more of a response under the next government than we will from this one. And then maybe counterintuitively, I think the Trump victory has an opportunity to be a catalyst for more change. I think continuity for Europe in this current negative trajectory is actually bad. Obviously, in the short term, it may make things slightly less painful. But again, sometimes Europe needs to be shocked into doing the right thing. So I have some sympathy with the argument that the prospect and reality of more confrontational relations with the US, maybe being caught in the middle of a US-China arrangement, may actually galvanize some positive response from Europe, which is very much needed.
Okay, that's a very interesting perspective. And I just kind of want to touch on very quickly, I know we're running out of time. We've talked a bit about the dollar. We've obviously just talked about the euro. We've talked about equity markets. We've talked a little bit about bond markets and where we think the pricing is correct or not correct on those. But I want to bring in this point about gold, which you touched upon earlier, Louis Vincent, in terms of the gold prices. Gold's been up over 30% this year. It's not looking to come down anytime soon. And also crypto has also been up. When we look at, it's been benefiting during this election. So in terms of geopolitical risk versus the Trump or Harris policy impact, how do you think the direction of these will change or not?
So that's of course another important question. I'll start off by highlighting that you've never ever in history had a year where gold was up more than 25% and the S&P 500 was up more than 25%. And right now it looks like we're heading that way. Yes, we can throw crypto in there as well. Of course, the backlog of crypto doesn't go very far. But you could look at this and say, okay, people are, it's looking like Turkey or Indonesia, where people sort of lose faith in their domestic bond market and they lose faith in their currency and they just want to own real assets. And so you buy equities because in an inflationary era, equities will always keep some value, and you want to own equities, and you want to own, precious metals. What's been interesting to me on the precious metal front is that up until a few weeks ago, the gold was sort of going up in a vacuum all by itself. Silver wasn't doing that great. Platinum was going nowhere. Palladium was going nowhere. And in recent weeks, mostly basically since China announced its stimulus, you've started to see a big catch-up trade in all the other precious metals. And look, the simple reality is, if we move to a world in which you have very easy fiscal policy, which is where we are today, a Fed that's cutting interest rates, again, which is where we are today, where you have China easing fiscal policy and easing monetary policy, where you have the ECB easing monetary policy, you're in a world where it's hard to imagine that gold really collapses. I think to get a big collapse in gold here, you either have to get a much more hawkish Fed than anybody anticipates. You have to either get a massive meltdown in emerging markets, because gold is also an emerging market play. People in India, when they get rich, they buy gold. People in China, when they get rich, they buy gold. But there's little sign of that happening today, of an emerging market meltdown. Quite the contrary. India is booming along, Indonesia is booming along, China is booming along. And then you get to your question of geopolitical risk. Now, the reality is geopolitical risks have amplified a lot in recent years. Of course, Russia invading Ukraine, all the tensions in the Middle East. And with that, of course, we've seen more gold purchases. So, could the end of those Middle East tensions or an end of Russia-Ukraine war lead to a collapse in gold? I don't buy it. I don't buy it, because even if those tensions come to an end, the real catalyst for the geopolitical move in gold was the Western world's decision to nationalize Russia's and to confiscate the holdings of Russian oligarchs, to confiscate the holdings of the Russian central bank. Once we did that, we basically told all rich people in the world, we basically told all the central banks in the world, that keeping all of your money in banks and computers was actually not safe, that you needed to keep at least some in gold or in Bitcoin that you could readily access. So you needed some assets outside of the system. Once we weaponized the system against people we didn't like, whether Russian oligarchs or Russia itself, and we can say, okay, forget it, we didn't mean it, it's all good now. I think Humpty Dumpty's broken, and all the king's men can't put Humpty Dumpty back together again. So I think that the bull market in gold has started. It's hard for me to see what breaks it from here.
And let me chime in. I'm 100% on the same page with General Louis Vuitton. I think, as you put it well, you have some combination of diversification and insurance against debasement. So that's the fiscal monetary angle, or expropriation. And they apply geopolitically, but they also apply domestically, and they are relevant for both gold and they are for Bitcoin. So structurally, very much on the same page. Two, how does this election factor into it? I would say only modest. So the bigger trend is much more important than the smaller impact of the election outcome. But clearly, Trump has found a new enthusiasm for crypto. So I think there is certainly a prospect that could be re-energized, reinforced by his victory. And that could be under presidency alone. It doesn't necessarily require Congress, even though it's not entirely irrelevant there. So I think for crypto, it's more the Trump victory. For gold, it may be more, because it's a bit more the debasement angle, and maybe more whether we will get unified government and a fiscal angle. But my third point, which is his caution, is gold is everybody's favorite now. And one interesting change in dynamic that we have seen is that for the last year or so, for the most part, we had seen a lot of buying in Asia and in the East, and in particular from retail and from the private sector, very little buying in the West. And now we're also seeing a lot of inflows into ETFs in gold and related securities. So it's not, I don't think this is a great moment to double down short term on the gold trade. If anything, may not be wrong to go slightly the other way for a short term trading opportunity, even if the long term trend is still further up, as I agree.
Okay, interesting points on gold there. Right. Finally, as we're towards the end of this, I just kind of want to focus on what we think markets may be getting wrong in terms of the policy suggestions or the manifestos. Again, we've had certain things said, not always said very clearly by either side. Really, are the domestic changes that could happen under a Trump or Harris presidency not being considered enough? We could see a change in the Supreme Court political composition. We could see other things that will move the needles potentially for investors in terms of how corporates are performing via, if we see changes in the labor market under a Trump administration or even under Harris administration, where there's both sides are talking about being a little tougher on migration, with Trump obviously being much, much tougher. So what do you think the markets are getting wrong potentially in terms of these US domestic policy changes? Or maybe they're not.
Look, I think the biggest quandary in the market today is, if we take a big step back, you're in a situation right now where the US is 4% of the global population. It's roughly 24% of global GDP. It's roughly a third of global profits and roughly 2/3 of the world MSCI market cap. So you look at this, it's, when I first came out to Asia, you had Japan was 40% of the world MSCI, and it was 17% of global GDP. And that discrepancy couldn't last. Today, the perception is, of course, you got U.S. exceptionalism, and that regardless of who gets elected, that U.S. exceptionalism stays. Now, staying with numbers, the U.S. today accounts for 40% of global budget deficits, and it accounts for 60% of global current account deficits. So to keep the show on the road, the U.S. is forced to attract a lot of foreign capital. Now, I think the U.S. is about to elect a president that a lot of foreigners feel deeply uncomfortable about, for better or for worse. That a lot of foreigners look at President Trump and think, this guy hates me. Now, I think that's because they take him literally rather than seriously. And I think that's perhaps where the market also gets things wrong, is, they listen to President Trump and they take all the protectionist rhetoric much more seriously than what he actually ends up delivering. And again, here, I'll just cite the Mexican example of 2017. Nonetheless, the fact remains that to keep the show on the road, the U.S. needs to attract a lot of foreign capital. And whether the coming years, the U.S. still has that ability in the face of a China that, as I mentioned, has leapfrogged the West in industry after industry and is rapidly gaining market share, but also rapidly making friends around the world. 10 years ago, the general perception was that A, China didn't have a diplomatic service, and that B, China didn't have any friends. It just had a few make-believe friends like North Korea and Pakistan, people that it paid to be its friends. I think that's a part that the world is really missing, is the progress that China has made diplomatically, the entries it now has all across the world, whether in Africa and in Southeast Asia, the fact that, China now exports more to Southeast Asian countries than it does to the United States. I think that in all of our focus on deglobalization, we've actually forgot that we're not going through deglobalization. Global trade is actually continuing to accelerate. It's just that we in the Western world are a smaller part of it. And so, you know, what are people missing? I think they're completely blinded to the unfolding rise of China, because they're blinded by all the negative stories on China's real estate bust, etc. And they're blinded to the extent to which the US is dependent on foreign capital and how fragile that could actually turn out to be.
Very interesting points. Ibrahim?
So my 3 points once again. I mean, to your specific point about maybe some of the social impacts, they're clearly potentially very, very significant. Traditional appointments. There's obviously a women's healthcare topic in this election, which is major for many people in this country, and these don't tend to be all that relevant for financial markets. One aspect I would highlight where they eventually, I think, in a tail scenario could become relevant for market is that you end up seeing a desire for very significant changes, and that would galvanize unrest on the street. I think it's unlikely, and maybe a comparison I would offer is what we saw in Israel over a year ago, where you saw protests manifest themselves in response to some measure of desired legislative and constitutional changes. So very significant issues, generally not market relevant, other than in that tail scenario. What are markets missing otherwise? To my mind, we mentioned a couple of things, the differential impact on China, maybe that bonds could do a little bit better around the election than some people think. But I also question what sometimes people say about the inflationary impact of potential Trump tariffs or Trump deportation. And that's partly because, as Louis Vuitton said, the bark is often much worse than the bite. The idea that he will impose universal, very high tariffs, to me, seems relatively implausible. Similarly, the degree to which we will see massive deportations, to me, seems unlikely. And even if some measure of these came about, how inflationary they directly would be, I would put a very big question mark on this. But I will end by saying, I mean, for markets, the question very often is not just what happens, but what's next. And if we had another hour, I would love to pick Louis Vuitton's brain about what's going on in Beijing right now, because I think it's very reasonable to think that what happens in China is going to be just as much or maybe more important for 2025 than what happens in this US election. And that's both because we have obviously significant developments in China, but also because there's sometimes a bit of an air pocket, those kind of 12 months post a US election where, you know, legislation is being ground out and those mills do grind rather slowly. So I think what markets will start focusing on is first how to position into 2025, but what are really going to be the drivers? And China certainly is among the most prominent ones there.
On this, thank you. Since you set it up, I have to say, next week, not only do we have the U.S. election, and followed by the Fed meeting, we also have China announcing what kind of fiscal stimulus it's going to be. We have the big fiscal meeting of the Chinese government. So everybody should rest well this weekend, because it's going to be a busy week next week.
Absolutely. Very much agree with that, because the market hasn't necessarily reacted positively to what China's said thus far, particularly in terms of the loosening of monetary policy. You've really not seen as much of a reaction as may have been hoped. So fiscal points will be very, very closely watched. Okay, we do have a couple of questions from the audience, so I just want to go into those very quickly. If the first one being, as the US yield curve steepens, can the greenback, the dollar, hold its own given still wide interest rate differentials?
So I'll be quick on it. I'm still positive on the dollar into next year. The dollar, the US economic and equity market or financial cycle are closely linked. Again, that would in the short term depend a little bit on the election outcome. But the point applies that a steeper US interest rate tends to be a bit of a challenge for the dollar. That's both directly because it may simply reflect that additional risk premium you need for inflation, for other risks, but also because indirectly it means that hedging FX risks, even if you have asset exposures in the US, becomes somewhat more attractive. So the steepening yield curve can be a bit of a headwind for the dollar, but I would still place that within a broadly positive US outperformance trend. So I think at the end, it's not the death toll for dollar performance.
Okay. Right. Second question that we have on coming through, if either of you can feel free to comment on this, is out of the two candidates, which candidate will work to reduce tensions or trade war with China? We've discussed China so much about this. This election feels almost less about the US and more about China in many ways. But do we get beyond the bluster, as you have said, in that he will do a deal if Trump wins? If Harris wins, will she really also look to do a deal, or will she be as tough, or will she be constrained in her actions one way or another by a Republican Congress, if we look at that?
So it's a super important question. Like I said, I'm sitting in Beijing today. It's a super important question for this part of the world. I'm actually decently optimistic on this, that either candidate ends up being better for the China relationship than what we've had today. Now, I think actually Trump ends up being the best of the two. Like I said, he's very transactional, and I tend to believe that Trump knows that he needs a deal with China if he's going to get strong growth and low inflation in the US at the same time. I also think Trump knows he's here for only one term. He's here for a good time, not a long time. He wants to maximize the growth as much as possible. So I think he would be better. Now, when it comes to Kamala Harris, it's harder to know because we don't really know who's part of her team. She hasn't really talked about foreign policy. It doesn't really seem to be a big concern of hers. And to be honest, I think if she comes in, she's probably going to think, if I'm going to get reelected, it's because I will have solved the border. It's because I will have tackled healthcare issues, because I'll have tackled education issues, the cost of education, the cost of healthcare. And so I don't think she'll be that focused on foreign policy. Nothing in her career leads you to believe that she'd be that interested in foreign policy, as opposed to Biden, for example, who's head of the Foreign Relations Committee in the Senate. And actually, I think that's better, because Biden brought with him a view of the world that was split between good democracies and bad non-democracies. If you remember when Blinken and Jake Sullivan sat down with Liu He and Wang Yi in Anchorage in May 21, Blinken sat down and said, you know what, we don't like you guys. You guys are communists. You're authoritarians. We don't want anything to do with you guys. At which point the Chinese said, well, that was a short meeting, and walked out. And now here's what we do know. We know that Kamala Harris and Blinken don't get along. Kamala Harris and Jake Sullivan don't get along. We also know that Biden was the only US president since Carter to not visit China, that Jake Sullivan only went to China once, and that was 2 months ago. So I think whoever comes next will be better, to be honest. I think they'll bring forward a vision of the world that is hopefully less Manichaean, less split between good versus bad countries, less a white hat versus black hat view of the world, which I think would be massively productive.
Okay, good response to that.
That was very interesting. I really don't have anything to add. I think benign neglect is the hope in the Harris victory outcome. But yeah, very interesting.
So benign neglect. That's going to be a new one for a discussion. Okay, very quickly, we have time, I think, for one last question. So I'm going to move quickly ahead, just because what you're talking about, that bit of benign neglect. Forecast for the Israel-Iran tensions after the election. Does Harris or Trump make any difference in this sense? When we think, again, going back to geopolitical alliances, does it matter?
Well, I will say, having grown up in Germany to Iranian parents, my main source of expertise is that I left the region when I was less than 4 months old. So I will say everything with with a large dose of humility. And my principal point would simply be, keep this risk on your radar, even this weekend, and certainly for the lame duck period. So there are many reasons to expect some degree of further escalation and perhaps in unexpected ways, and some speculation that could happen even before actual election day. So the next couple of days are relevant in that regard as well. And then my second point would just be, we kind of know how Trump likes to operate. He doesn't really care about general conventions. He doesn't care particularly about international law, but he doesn't like to be taken advantage of. So as much as there is some perception of where the relative preferences of the different candidates are, I think what will end up being relatively beneficial is that I think it'll be much more clear what the policy orientation will be, and I think that's relevant for financial markets. I'm slightly hopeful that it may actually end up being helpful for generating outcomes, because at the end of the day, you know, an end with horror is better than horror without end. So I think, you know, in that calamitous present situation that the Middle East faces, that's more a hope that I would express, and by no means a forecast.
Absolutely. Okay, I think we are at the point where we have run over time. We've now been chatting. We can keep going on this for quite a long time, I think. There's so much to cover. Well, thank you both for participating within this. We did have one question we didn't quite get to. Maybe I can stick in very, very quickly. Hopefully our audience will be patient with us. It's really the fact that the stock market seems happy no matter what at this point in time. You've talked about the risk premium not being in there necessarily. Right now, the stock market seems happy. We have a strong U.S. economy. We've pretty much ascertained that that's pretty much the case. Is that agreed that right now, or at least for the immediate future, after the election, stock markets are still going to remain relatively happy? They're going to be focused on what's happening in terms of corporate earnings.
Yeah, and I think, look, we have reflationary policies everywhere. You know, U.S. has super easy fiscal and easing monetary. China's is easing fiscal and monetary right now. Europe is easing monetary policy. Everywhere you care to look, you've got stimulative policies. So, you know, why would you want to stick around in bonds? Yeah, it makes a lot more sense to be hanging out in equities against that policy backdrop.
Yeah, and I very, very much agree. Only caveat I offer is, as you said, everybody seems to be agreeing right now, and I think that's most relevant just for that immediate window around the election. We talked about it. Equities could maybe face a little bit of a setback on a bit of indigestions in bond yields, on the surprise Kamala Harris victory, or simply on profit taking. So there is some room for very short-term volatility. Now may not be the time to chase, but overall, I'm very much in the camp that we'll see a positive environment for risk assets into next year.
Great. Well, thank you both very, very much it's been a wonderful conversation, and we'll all be looking very closely, staying up very late in my case in London, to take a look at what's coming through with the US election, who's won, by what margin, if we know, how quickly we'll know. And we will have to wait and see whether or not markets, if we have any surprises in store. But we all seem to think that they really won't at this point. And with that, thank you again. And thank you to the audience for tuning in to our US election special.